Part 1. Understanding inflation and interest rates. Inflation and interest rates are two of the most misunderstood forces in financial markets. Most people believe inflation simply means prices are rising, while interest rates are viewed as mechanical policy tools controlled by central banks. This surface-level understanding causes many investors to make decisions at exactly the wrong time in the market cycle. In reality, inflation and interest rates form the foundation of every macroeconomic and financial cycle. They shape liquidity, influence behavior, and determine how capital flows across asset classes. Inflation is not the problem. Inflation is the signal. At its core, inflation measures the rate at which purchasing power erodes. When inflation rises, each unit of currency buys less than before. When inflation slows or falls, purchasing power stabilizes or improves. This change in purchasing power affects everything: consumer spending, corporate margins, wage growth, investment decisions, and ultimately asset valuations. Contrary to popular belief, central banks do not directly control inflation. They respond to it. When inflation accelerates beyond acceptable levels, central banks raise interest rates, not to punish markets but to slow economic activity. Higher interest rates increase the cost of borrowing, reduce leverage, and discourage speculative behavior. Over time, this dampens demand and helps bring inflation back under control. This is where confusion begins for many investors. The common assumption is that high interest rates are automatically bad for markets. But history tells a far more nuanced story. Markets do not react to the absolute level of interest rates. They react to the direction, momentum, and expectations surrounding those rates. Rising rates from extremely low levels often reflect economic strength and expanding activity. They signal that growth is strong enough to absorb tighter financial conditions. In contrast, rates approaching a peak, or transitioning from acceleration to stabilization, often indicate a shift in liquidity conditions beneath the surface. Interest rates are not about the present. They are about expectations. Financial markets are forward-looking systems. Asset prices reflect what investors believe will happen 6 to 12 months ahead, not what is happening today. This is why markets frequently rally before inflation is fully under control, and why markets can decline even when inflation data appears positive on paper. Retail investors often wait for confirmation. They wait until inflation is clearly falling. They wait until central banks officially announce rate cuts. They wait until headlines turn optimistic and uncertainty disappears. By the time confirmation arrives, the market has already repriced. This creates one of the most common psychological traps in investing. Central banks do not lead markets. Markets front-run central banks. Every tightening cycle follows a familiar structure. Inflation rises. Interest rates increase, liquidity tightens, risk assets struggle. But the turning point rarely occurs when inflation reaches its lowest level. It usually occurs when inflation stops getting worse. This distinction is critical. Markets do not require perfect conditions. They require improving conditions and declining uncertainty. When inflation peaks, even at elevated levels, markets begin to stabilize. When the pace of rate hikes slows, liquidity pressure starts to ease even if rates remain high. Understanding this difference separates macro investors from reactive traders. Those who focus on expectations, momentum, and liquidity positioning gain an edge. Those who focus only on headlines tend to arrive late. Interest rates are not weapons, they are signals. And the biggest mistake retail investors make is reacting to current data instead of positioning ahead of changes in expectations. In macro investing, timing is rarely about certainty. It is about understanding where we are in the cycle and where the system is likely heading next. Part 2. How interest rates control liquidity and asset prices. Interest rates do not move markets directly. They move liquidity. Liquidity represents the availability of capital willing to take risk. It is not just about money existing in the system, but money being active, confident, and willing to flow into assets with uncertainty attached to them. When liquidity is abundant, capital moves into equities, crypto, growth assets, and speculative investments. Valuations expand. Risk tolerance increases. Volatility is tolerated rather than feared. Investors are rewarded for taking risk early, before consensus forms. When liquidity contracts, capital retreats toward cash, bonds, and defensive assets. Leverage is reduced, volatility is punished. Risk assets suffer prolonged drawdowns not because fundamentals disappear overnight, but because capital becomes scarce and cautious. This shift is not emotional, it is mechanical. Interest rates shape liquidity by influencing incentives across the entire financial system. Higher interest rates absorb liquidity from markets. They increase the opportunity cost of holding risk assets. They make safe assets more attractive relative to speculative ones. They tighten financial conditions across banks, corporations, and households simultaneously. Borrowing becomes more expensive. Credit availability shrinks. Refinancing risk rises. Balance sheets become more fragile, especially for leveraged participants. But here's the insight most investors miss. Liquidity conditions shift before official rate cuts occur. Banks adjust lending standards early. They tighten credit when they expect economic stress, and loosen credit when they expect stabilization. Institutions reposition portfolios months ahead of policy changes. Risk managers adjust exposure based on expectations, not announcements. This is why markets often bottom while interest rates are still high. Retail investors frequently ask, how can markets rise when rates are still restrictive? The answer is simple. Because liquidity expectations have already changed. Markets are forward-looking. They price the next move, not the current one. When investors believe rate hikes are nearing an end, risk appetite begins to return. Not suddenly, not explosively, but quietly and selectively. This phase is known as the accumulation phase. Smart money builds positions while uncertainty remains high. They accept discomfort in exchange for asymmetric opportunity. They do not need perfect data. They need improving conditions at the margin. Retail investors wait for confirmation, clarity, and positive headlines. By the time confirmation arrives, prices are already higher, and risk-reward has deteriorated. This pattern repeats throughout history. In 2009, equity markets bottomed while unemployment was still rising and economic data remained weak. In 2020, massive liquidity expansion began before recovery appeared in official statistics. In crypto cycles, Bitcoin often rallies months before macro conditions appear safe or supportive. Interest rates act like gravity. They do not instantly crash markets. They apply pressure over time. The longer rates remain high, the more fragile leveraged positions become. Weak participants are forced out slowly, then suddenly. But once the pressure stops increasing, markets stabilize. This distinction matters. Markets do not need rate cuts to rally. They need the absence of further tightening. This is why narratives are dangerous. Headlines focus on rates are still high. Inflation remains above target. Central banks stay hawkish. Smart money focuses on something different. Rate velocity. Liquidity direction. Financial conditions. Markets do not collapse because rates are high. They collapse when liquidity tightens faster than expected. And markets do not rally simply because rates are low. They rally when liquidity expands faster than expected. Once this framework is understood, macro cycles become predictable, not in precise timing but in structure. Interest rates are not about fear. They are about capital flow. Part 3. Positioning through the risk cycle. Most investors lose money not because they lack information, but because they enter markets at the wrong time. They buy when certainty feels high. They sell when fear dominates. This pattern is not accidental. It is human nature. Interest rate cycles amplify this behavioral mistake. Retail investors feel safest after rate cuts begin, after inflation clearly falls, after positive headlines return, after volatility declines and narratives turn optimistic. But safety in markets is often an illusion. By the time conditions feel safe, much of the opportunity has already passed. Prices reflect comfort, not value. Risk-reward deteriorates quietly while confidence increases. The real opportunity appears earlier. It appears when uncertainty is still high, but conditions are improving beneath the surface. When pessimism remains dominant, yet pressure is no longer increasing. When expectations are low, but reality begins to surprise to the upside. Smart money does not wait for clarity. It waits for asymmetry. Asymmetry exists when downside risk declines faster than upside potential, when forced selling slows, when liquidity stabilizes, when macro pressure stops worsening, even if it is not yet clearly improved. This is when positioning begins. This is why accumulation typically occurs during rate pauses, slowing inflation momentum, and stabilizing liquidity conditions. Not during perfect environments, not during visible economic strength, not during widespread optimism. Macro investing is not about calling exact tops or bottoms. It is about aligning with the dominant regime. Risk-on environments emerge when liquidity expands, rate pressure eases, and capital seeks return rather than protection. Risk-off environments dominate when liquidity contracts, rates accelerate higher, and capital prioritizes safety and preservation. These regimes are slow-moving, but they are powerful. They shape asset performance far more than daily headlines or short-term data releases. Your role as an investor is not to fight these forces. It is to recognize them early and position accordingly. Interest rates are only one part of the system, but they influence everything: liquidity, valuations, sentiment, leverage, and narratives. They determine whether capital is rewarded for taking risk or punished for it. Retail investors react to outcomes. Professional investors position for transitions. Retail chases performance. Professionals accumulate during discomfort. The difference is not intelligence. It is patience and structural understanding. This is why macro positioning often feels uncomfortable. It requires acting before narratives change, before data looks perfect, before consensus agrees. The goal is not to predict the future with certainty. It is to recognize when the balance of risk is shifting, when markets are no longer deteriorating, even if they are not yet clearly improving. This is where long-term edge is created, quietly, patiently, while most are still waiting for confirmation. When interest rates are viewed as part of a cycle rather than daily headlines, markets stop feeling chaotic. They begin to feel structured. Movements that once felt random begin to make sense. Volatility is no longer something to fear blindly. It becomes information, a signal of transition, not failure. This perspective changes behavior. Instead of asking, "Is now safe?" the better question becomes, "Is pressure increasing or decreasing?" Instead of reacting to news, investors observe liquidity. Instead of chasing certainty, they seek asymmetry. This is the core lesson of the risk cycle. Markets reward those who can act before certainty appears. They punish those who wait for comfort. Once structure is understood, fear diminishes, because uncertainty is no longer random. It is expected, and expected uncertainty is opportunity. Thank you for watching. What's your take on today's market? Share in the comments below. If this video helped you understand market cycles, like and subscribe for more insights from Macrocycle Lab. See you in the next video.